ever pondered over the term ex-dividend in the world of stocks? Does it remind you of your ex? Well, it might not be as complicated or dramatic as that relationship. Today, we're diving into the world of dividends, specifically the concepts of ex-dividend and post-dividend prices. Which one you prefer, you ex or your future post? Picture this, you're in the market to buy a stock. You see that the company has declared a dividend. Now, you might think, hey, if I buy the stock now, I'll get the dividend too. But the stock market, like life, isn't always that straightforward. Here's where the concept of ex-dividend comes into play. The term ex-dividend literally translates to without dividend. On the ex-dividend date, the stock starts trading without the dividend. If you buy a stock on its ex-dividend date or after, you will not receive the upcoming dividend. Instead, the seller of the stock will receive the dividend. Now, why does this happen? Well, dividends aren't instant. There's a process and it takes time. When a company declares a dividend, it also sets a record date. Only shareholders who own the stock before the record date are entitled to the dividend. The ex-dividend date is typically 2 trading days before the record date. This allows all trades that occurred before the ex-dividend date to settle. So, what happens to the stock price on the ex-dividend date? The stock price typically drops by about the amount of the dividend. But don't worry, this is not a cause for panic. It's a natural adjustment to account for the outgoing dividend. Now, let's move on to post-dividend prices. This is the stock price after the dividend has been paid out. Post-dividend prices can be influenced by how the market perceives the company's ability to generate future profits and pay dividends. If the market has confidence in the company, the stock price may rebound to its pre-dividend level or even higher. So, is buying a stock at ex-dividend price or post-dividend price better? Well, it depends on your investment strategy. If you're an income-focused investor who relies on dividends, you'll want to buy the stock before the ex-dividend date. But if you're more focused on the stock price, the ex-dividend date might not matter as much to you. In summary, the ex-dividend date is the date when the stock starts trading without the dividend. If you buy a stock on or after the ex-dividend date, you won't receive the upcoming dividend. The post-dividend price is the stock price after the dividend has been paid out and can be influenced by the market's confidence in the company. Remember, understanding these concepts and how they can impact your investment strategy is crucial to making informed decisions in the stock market. Whether you're buying at ex-dividend or post-dividend prices, remember to do your research and consider your financial goals. After all, the stock market isn't just about buying and selling, it's about investing in your future. This report is brought to you by Kawami's Financial Services. We bring financial transparency and education to all users all over the world. Please like, share, and subscribe to our channel to receive our latest new reports in finance. Remember, Kawami's means financial knowledge is power.